In this video, we're gonna present about the closing entry.
We have two objectives. The first, the purpose of making a video is to know how to complete a closing entries, and discussion. We have three discussions. The first, definition of closing entries. The second, function of closing entries, and the last, type of account to be closed.
And now I will explain about the definition of closing entry. A closing entry is a journal that is made at the end of accounting period to transfer balances from a temporary account to a permanent account. Companies use closing entries to reset the balances of temporary accounts to accounts that show balances over a single accounting period to zero. By doing so, the companies moves these balances into permanent accounts at the balance sheet. These permanent accounts show a company's long-standing financial.
Next, I will explain about function of closing entry. The function of closing entry is to adjust the account balance to zero so as not to affect transaction in the next period. Type of account to be closed. The first, all revenue account. Second, all expense account. And the last, private.
Closing entries are typically done at the end of an accounting cycle, and their main purpose is to reset accounts that are temporary to a balance of zero. What I mean by temporary accounts is we all have those certain things that we budget during the year. So for example, I might go ahead and keep track of the amount of income that I have for all of 2017. So I'll keep adding and adding and adding, and eventually at the end of 2017 I'll have a number in that account and I'll say I have this much in income. However, at the end of 2017 I obviously want to prepare for 2018, so is that balance going to continue and roll over to 2018? No, in 2018 I want to start fresh. I want to start with zero so I can see how much I earned in 2018. So that's the same kind of thing that we are going to do here. We are going to find out those accounts that we have to close out to a balance of zero. So let's take a look at these account types and talk about whether or not we would want to start a new period with a balance of zero. So remember, your assets are things that you own, those future economic benefits. So think about cash. If I go to sleep on December 31st with $10,000 in my checking account, does that balance go away at the beginning of the next day on January 1st? No. So that one has an ongoing balance. So this is what we would call a permanent type of account. Liabilities are the same. Does the amount I owe disappear just because it's a new accounting period? No. My liabilities are going to stay there no matter what. Capital. Now, capital is a bit of an interesting case. Our main capital account, for example, Christopher Knowles Capital, that one is a permanent account. The interest in the company, it's not going to be closed out to a balance of zero. However, your drawing, that is one that would be considered temporary. So if we had a balance in this drawing account, we would want to set that to a balance of zero. And even though we do not have a balance of zero in this account, I am going to show in this example what we would do if we did have one. So let's move on to this next one. And actually, let's even go ahead and put some P's next to these assets for permanent, and a P next to these liabilities since those are all permanent, and a P next to that capital since that one's permanent, and then drawing would be temporary. Okay, next, income and revenue. So income and revenues, would I want to close that out to a balance of 0 for the next period? Yeah, I want to start fresh during the next period. I want to see what my income is from one period of time to the next. And the same with expenses as well. Expenses, I want to see how much I earned during a specific period, and once I start a new period, I want to start out with 0. So all of our revenues, which we only have 1 in this case, and all of our expenses, those are all going to be temporary. Okay, next, let's go ahead and talk about closing entries in general. There are 4 closing entries that we typically see. 1, 2, 3, 4. Now, each one has a specific purpose, and I'm going to write those purposes up right now. However, keep in mind it might be a little vague, but it will make sense a little bit later. So your first closing entry closes revenues to income summary. Now your income summary, this is just kind of a temporary intermediate account that we use just for the closing process. Your second closing entry closes expenses to income summary. Your third closing entry will close income summary. So there we go. We created it and we're killing it here. And we close the income summary to capital. And then your final closing entry is to close drawing to capital. So let's go through each of these individually. Your first one is to close revenues to income summary. So let's find that one revenue account we have here. Fees earned. Now notice that fees earned currently has a balance of 10,000 credit. Well, how are we going to decrease that to a balance of 0? How do we close that out? Well, we do the opposite. We debit. And also you can kind of look down here. We have a credit as our normal balance, so to get rid of it, we debit. That decreases it. So let's start by debiting that fees earned account for our first entry, $10,000. Now looking at this guidance we have down here, where do we close revenues to? Well, we close it to income summary. Now that we've completed that first one, closing revenues to income summary, let's move on to our second closing entry, closing expenses to income summary. Now let's take a look at our expenses. We have 1, 2, 3, 4 expenses here, and this one with a balance of 0, so you don't have to worry about that one. So here, our expenses have a debit balance. Well, how do we close that out to 0? We do the opposite. We have to credit them. So let's go ahead, put in our date. And then I'm going to skip a line and I'm going to start crediting all of those expenses. So we have wages expense, supplies expense, rent expense, and insurance expense. Remember, since this one has a balance of 0, we don't have to worry about it. It already has a balance of 0, so we do not have to close it. Okay. Now, once we have closed our expenses, what do we close it to? Well, income summary again. So let's go ahead and use income summary as our plug. And remember, our rule, debits must always equal credits. So 700 plus 1,200 plus 3,000 plus 500. That gives us total expenses of 5,400. Now that we have our first 2 closing entries, our third one is to close income summary to capital. Now our income summary account, so far we have credited it for 10,000 and we have debited it for 5,400. So let's remember those rules. We're going to use a T account to really analyze this to see what's going on. If I have a debit of 5,400 and a credit of 10,000, well, what's the balance in that account? Well, that debit of 5,400 offsets the credit of 10,000. We have more on this side. Think of it kind of like a scale. So we have a balance of 10,000 minus 5,400, 4,600 in that account. And just to kind of deviate just slightly, let me pull up our old financial statements. Here we go. If you take a look at our financial statements, that income statement we did earlier, we had our revenues, fees earned, all of our expenses, and our net income was 4,600. Well, where did that 4,600 flow to? What was the effect of that? That 4,600 came down to our statement of owner's equity, and ultimately it increased Christopher Knowles' capital. So it increased capital. Okay, now that you've seen that, let's go ahead and head back. There we go. So maybe this will help bring everything together. So on this third one, we need to close income summary to capital. So what is the balance in income summary right now? It's a credit of 4,600. How do we get that to a balance of 0? Well, we do the opposite. We debit it. So let's do our third closing entry. Closing out income summary by debiting income summary by 4,600. Now income summary, since we just debited it right here. Now income summary has a balance of 0. And that would be the final balance in that account. Go. So as you can see, we created it in the first entry and then we killed it in the third entry. So it's just a temporary intermediate account that we use just for the closing process. So now let's finish up this third entry because obviously we're missing something here. What do we always close our income summary account to? That would be capital. So let's take a look at our capital account right here. Charles Knowles Capital, and that will be our credit. Oops, sorry, Christopher Knowles Capital for 4,600. Now let's take a close look at what that did to capital. We just credited a capital account, so that increased capital. So I can actually drag these down a little bit. There we go. Now they're lined up. That was a little confusing. So capital right here is increasing because we credited it. So what exactly does that mean? We just increased capital. Well, where else did we increase capital? Well, we increased capital over on our statement of owner's equity when we did our financial statements. So basically, what these closing entries are also doing, their secondary purpose. Their first purpose is to close out all of our temporary accounts. Their secondary purpose is to update capital to its new balance. So let's think about what's really going on here. If we had previously, let's find where we...
And that's all from us. Thank you and bye-bye.
Bye.
And now I will explain about the definition.
Type of account to be closed. First,
Ah.